Every seasoned market participant understands the meticulous charts, the intricate indicators, and the countless strategies designed to extract profit from the fluctuating tides of the market. Yet, many fail to grasp that beneath this veneer of logic and analysis lies a powerful, often unseen force dictating their ultimate success or failure: fear. It's the invisible hand that grasps the trader's wrist, not allowing them to open the position their analysis demands, or worse, compelling them to commit capital far beyond reason. This isn't just about making a mistake in calculation. It's about a deeply ingrained emotional imbalance that actively sabotages the very foundation of intelligent trading: position sizing. Imagine a well-researched trade, one with a clear entry, a logical stop, and substantial profit potential. The analysis is sound, the signals are aligned, yet something whispers doubt. That whisper, born of the fear of loss, manifests as an unnatural hesitancy. It compels a trader to take a position far too small, to dip a mere toe into an ocean of opportunity. The result? Insignificant gains, even when the market moves precisely as predicted. This leads to a pervasive sense of frustration, a feeling of being perpetually behind, unable to capitalize fully on their own undeniable market insight. Conversely, the market presents an alluring, fast-moving opportunity, perhaps one that has already begun to run. The fear of missing out, FOMO, a sibling to the fear of loss, seizes control. This isn't the calculated aggression of a confident market operator. It's the desperate lunge of someone terrified of being left behind. It pushes a trader to commit an exorbitant amount of capital, to take a position far exceeding their risk tolerance, all in a frantic effort to catch a move they perceive as easy money. The consequence is a fragile, over-leveraged position that shatters at the first sign of volatility, turning potential profit into certain pain. Consider the narrative of countless trading careers, marked by fleeting successes undermined by crippling setbacks. Often, the root cause isn't a lack of market knowledge, but a profound inability to master the self, particularly in the critical domain of capital allocation. This emotional puppeteer, fear, distorts judgment, transforms logical analysis into timid hesitation or reckless abandon, and ensures that the trader never truly operates with optimal efficiency. This discussion isn't merely an academic exercise. It's a stark revelation of the psychological warfare waged within every trader's mind. We will expose the true nature of this emotional manipulation and provide the undeniable keys to asserting control. Your position sizing must become a precise instrument of your strategy, not a battleground for your anxieties. The power to control your capital, and thus your destiny in the markets, rests on understanding and mastering this fundamental truth. Despite meticulous backtesting and a robust trading plan, many traders find themselves caught in a profound psychological dissonance. They intellectually grasp the mechanics of proper position sizing, understanding the mathematical imperative of risking a defined percentage of capital. Yet, when faced with the live market, an irrational sense of fear overrides logic, creating a chasm between knowledge and execution. This internal conflict is a primary driver of costly errors, eroding consistency and ultimately hindering sustained profitability. The lingering shadow of past losses casts a long, cold pall over future endeavors. A series of losing trades, however small, can instill a deep-seated apprehension that projects onto every subsequent opportunity. This manifests as an involuntary reduction in position size, even when the current setup boasts a high probability of success. The trader, still nursing old wounds, unconsciously prioritizes minimizing potential pain over maximizing potential gain, crippling their capacity to recover and grow. A common illusion perpetuated by fear is that of control through diminishment. The anxious mind convinces itself that by taking an infinitesimally small position, it is somehow controlling the inherent risk of the market. In reality, this self-deception merely controls the potential for substantial profit, rendering even perfectly executed trades largely inconsequential. It's an act of self-sabotage, a retreat from opportunity disguised as prudence, ensuring that the market's favorable movements never truly translate into meaningful capital appreciation. The true adversary in trading is not the market itself. The market, in its impersonal fluctuations, simply presents opportunities. The real battle is waged within the confines of one's own mind, against the insidious forces of emotion. Until a trader genuinely understands and confronts these internal antagonists, particularly fear, they will remain perpetually reactive, constantly struggling against an invisible enemy that dictates their actions. Mastering this inner landscape is the fundamental prerequisite for achieving any lasting success. Learning to recognize the subtle signals of fear during the decision-making process is a critical skill. It's not just about a racing heart. It's the subtle hesitation before clicking buy, the sudden urge to double-check every parameter, the nagging internal voice that questions every aspect of a meticulously planned trade. These are the telltale signs that emotion, specifically fear, is attempting to usurp control over your position sizing. By becoming acutely aware of these internal shifts, a trader can pause, acknowledge the emotional interference, and consciously choose to adhere to their predefined, logical plan. The most immediate and painfully obvious consequence of allowing fear to dictate position sizing is the forfeiture of substantial profits. Imagine identifying a prime setup, executing the entry flawlessly, and watching the market move precisely in your favor. Yet, because fear compelled you to take an infinitesimally small position, the resulting gain is negligible, a mere fraction of what the market was truly offering. This isn't just a missed opportunity, it's a profound self-inflicted wound, demonstrating a fundamental failure to capitalize on one's own analytical prowess. This chronic underinvestment, born of excessive caution, inevitably breeds deep frustration and a propensity for self-sabotage. The constant realization of meager returns, even on winning trades, creates an insatiable urge to catch up. This emotional pressure often leads to impulsive, oversized, and recklessly taken positions in an attempt to quickly recoup lost potential. This desperate lunge, ironically, often results in significant losses, spiraling the trader further into a cycle of despair and reckless behavior. Moreover, persistent timidity erodes a trader's confidence in their own ability to accurately read the market. Each undersized winning trade, rather than building conviction, subtly reinforces the idea that true success is unattainable. This creates a vicious cycle where a lack of confidence fuels further caution, which in turn leads to underwhelming results, further diminishing self-belief. The trader becomes trapped in a self-fulfilling prophecy of mediocrity, unable to break free from the very fears they desperately wish to escape. In a profound paradox, the very fear of loss becomes a self-fulfilling prophecy when it dictates diminutive position sizing. By reducing the size of their bets, traders ensure that even when they are fundamentally correct about market direction, their profits are so constrained that they struggle to cover even minor transaction costs or occasional small losses. This inadvertently confirms the initial fear that significant gains are elusive, reinforcing a conservative approach that stifles real growth. It is imperative that traders honestly confront the ledger of their past endeavors. Look beyond the P&L and examine the unrealized potential. How many times did you identify a significant market move but failed to capitalize adequately due to an overly cautious position size? Acknowledging these missed opportunities, not with regret but with objective understanding, provides a powerful impetus to break free from the chains of timidity. This clear-eyed assessment reveals the true cost of fear and the imperative for precise, calculated risk. While fear of loss often leads to overly small positions, its deceptive sibling, the fear of missing out, FOMO, often pushes traders to commit excessive capital. When a market is rapidly accelerating, seemingly leaving everyone behind, the siren song of quick, easy profits becomes almost irresistible. This isn't a rational assessment of opportunity. It's an emotional reaction driven by the terror of being excluded from the gains, compelling a trader to jump in with an oversized position, often at a precarious entry point, risking far too much on a single, emotionally charged trade. Another perilous manifestation of fear, disguised as aggression, is the desperate need to get back to even after a series of losses. The sting of past defeats creates an irrational compulsion to recoup capital quickly, overriding all principles of sound risk management. This often leads to a drastic increase in position size on the very next trade, transforming a calculated risk into an all-or-nothing gamble. This impulsive leap of faith, driven by the fear of staying behind, is one of the quickest and most reliable routes to catastrophic account depletion. Even seemingly positive emotions can mask underlying fears. A sudden, significant profit or an unexpected winning streak can induce a dangerous sense of euphoria. This heightened emotional state, while appearing beneficial, is often another form of fear. The fear of missing out on easy money, or the fear that the winning streak might end. This can lead to reckless overconfidence, prompting a trader to scale up their positions far beyond what their strategy or capital dictates, believing they have unlocked some secret, infallible method. High position sizing acts as a powerful amplifier for emotional responses. When a disproportionate amount of capital is at stake, every tick of the market is magnified, transforming minor fluctuations into gut-wrenching swings. This increased volatility and personal P&L makes a trader incredibly vulnerable to panic, irrational decision-making, and premature exits. The pressure becomes immense, clouding judgment and pushing even experienced traders to abandon their plans in the face of perceived overwhelming risk. The only reliable shield against these potent emotional temptations is an unwavering commitment to iron discipline. It means adhering strictly to predefined risk parameters, regardless of how compelling the market appears or how strong the emotional urges become. Discipline allows a trader to resist the siren call of greed and the paralyzing grip of FOMO, ensuring that position sizing remains a function of objective calculation rather than subjective emotional pressure. Without this unwavering commitment, even the most brilliant analytical mind will inevitably fall prey to the market's psychological traps. The core principle governing rational position sizing is profoundly simple, yet consistently violated. Your position size must be derived from a fixed percentage of your total trading capital, representing the maximum amount you are willing to risk on any single trade. This is not an arbitrary number pulled from thin air. It is a meticulously calculated figure that ensures the longevity and resilience of your trading account, independent of your emotional state. This disciplined approach removes subjective bias, transforming position sizing into an objective, repeatable process. Central to this calculation is the precise placement of your stop loss. The stop loss is not merely an exit point. It is the linchpin that determines your risk per share or per contract, and thus, ultimately, your position size. A logical stop loss, based on technical analysis or predefined risk parameters, defines the maximum potential loss on a trade. This numerical value, combined with your predetermined percentage of capital risk, forms the objective basis for how many shares or contracts you can responsibly acquire. It is a mathematical relationship, not an emotional one. Every professional trader must know their number before entering any trade. This number is your absolute maximum permissible loss in dollar terms for that specific trade. This figure, derived from your capital and your chosen risk percentage, becomes the non-negotiable ceiling for your exposure. It is this objective value, not a surge of confidence or a pang of fear, that dictates the volume of your commitment. When this number is clearly defined, the emotional component of sizing diminishes significantly. While the fundamental principles are universal, the specific individual risk tolerance can vary. A trader might choose to risk 1% of their capital per trade, while another might opt for 0.5% or even 2%. This percentage should align with one's psychological comfort level and overall risk profile. But once established, it must be rigidly adhered to. The percentage itself is less important than the unwavering consistency in its application. Any deviation, upwards or downwards, opens the door to emotional interference. Ultimately, proper position sizing is a mathematical equation, not an emotional gamble. It is a calculation performed before the trade is initiated, before the market's live movements can inject fear or greed into the decision-making process. By reducing position sizing to a purely quantitative exercise, traders strip away its emotional leverage, ensuring that every allocation of capital is a strategic maneuver rather than a reactive impulse. This objective approach is the bedrock of disciplined, consistent profitability. True mastery in trading hinges upon the ability to emotionally detach from the outcome of any single trade. This is not an invitation to recklessness, but a profound understanding that trading is a game of probabilities played out over a multitude of events. Each individual trade is merely one spin of the roulette wheel, one flip of the coin in a series of thousands. Its solitary result, whether winning or losing, does not define the trader's overall skill or the validity of their system. This detachment liberates the mind from the suffocating grip of immediate profit or loss. Instead of fixating on the fluctuating P&L of an open position, the focus must shift entirely to the quality of the execution process. Did you identify the setup correctly? Was your entry precise? Was your stop loss placed logically? Most critically, did you adhere to your predefined rules for position sizing? By centering attention on these controllable variables, rather than the uncontrollable market outcome, a trader cultivates a sense of control and competence, regardless of whether a particular trade proves profitable. Embrace the mindset of large numbers. A successful trading career is built not on a handful of spectacular wins, but on the consistent application of a sound methodology over hundreds, even thousands, of trades. Each individual trade is statistically insignificant in isolation. Its primary purpose is to contribute to the larger statistical edge. When this perspective is adopted, the emotional weight of any single trade diminishes, making it easier to maintain rational position sizing and avoid impulsive adjustments. Even the most disciplined trader will occasionally experience moments when emotions begin to overwhelm logic. This is where an emotional stop loss becomes invaluable. It's the predetermined recognition that if fear, frustration, or euphoria reaches a certain intensity, the most prudent action is to temporarily step away from the market. This isn't quitting. It's a strategic retreat to preserve capital and mental clarity, preventing emotionally compromised decisions from spiraling into catastrophic errors in position sizing. The path to consistent profitability is paved not with massive, speculative bets, but with the unyielding power of consistency. Stable returns are the direct result of disciplined, repeatable actions, chief among them the unwavering application of proper position sizing. When a trader consistently risks a defined small percentage of capital per trade, the inherent statistical edge of a sound system inevitably plays out. leading to compounding gains. It is this steadfast adherence, not heroic gambles, that builds lasting wealth in the markets. The foundation of unwavering discipline in trading, particularly regarding position sizing, lies in highly developed self-awareness. A trader must cultivate an almost detached observation of their own emotional and psychological reactions as they unfold in real time. This means recognizing the subtle surge of anxiety when considering a larger size, or the insidious whisper of greed when a trade is running. By understanding these internal shifts, a trader gains the crucial ability to intervene and course-correct before emotions hijack their logical process. To foster this internal calm and clarity, practices like mindfulness and meditation are not merely abstract concepts, but practical tools for the serious trader. Even short, consistent periods of focused breathing or mindful observation can significantly enhance a trader's capacity for objective decision-making. These practices train the mind to observe thoughts and feelings without immediate reaction, creating a buffer between impulse and action, which is critically important when setting and maintaining position size. A meticulously kept trading journal is far more than a record of entries and exits. It's a psychological blueprint. Beyond the technical details, a trader must log their emotional state before, during, and after a trade, specifically noting any urges to deviate from their planned position size. This allows for post-trade analysis, identifying recurring emotional patterns and their detrimental effects. The journal becomes a mirror, reflecting the psychological influences that shape capital allocation decisions. Mistakes are inevitable in trading. The truly successful individual doesn't fear them, but rather embraces them as invaluable lessons, especially those errors stemming from emotional mismanagement of position size. Each instance where fear led to an undersized winner, or greed to an oversized loser, provides profound insights. By dispassionately analyzing these errors, a trader can refine their emotional control strategies, strengthening their mental resilience and preventing the repetition of costly psychological blunders. In the face of market volatility and personal emotions, the relentless pursuit of objectivity is paramount. Instead of relying on gut feelings or emotional impulses when determining position size, a trader must anchor their decisions in verifiable data, technical levels, and predefined risk parameters. This means calculating the position size based on the distance to the stop loss and the predetermined risk percentage, rather than a subjective assessment of how good a trade feels. This unwavering commitment to objective metrics is the bulwark against emotional sabotage. One of the most potent defenses against emotional interference in position sizing is the principle of pre-commitment, often summarized as set it and forget it. This involves defining every critical parameter of a trade, entry, stop loss, profit target, and crucially position size, before the market opens or before the trade is executed. Once these parameters are established, based purely on logical analysis and risk management rules, the trader commits to executing them without deviation, regardless of subsequent emotional urges or market noise. Beyond individual trades, a truly resilient trader engages in scenario planning. This involves anticipating various market outcomes, a sudden loss, an unexpected profit, a prolonged chop, and predetermining how they will react and adjust their capital allocation strategy emotionally and practically. By mentally preparing for these eventualities, a trader avoids panic or euphoria, ensuring that their position sizing remains consistent with their overall risk framework, rather than being a reactive response to unfolding events. The essence of mastery in trading lies not in a mystical ability to predict market movements, but in the unwavering discipline to execute one's plan, even when internal temptations are raging. This means sticking to the calculated position size when a trade feels too good to be true, and equally, resisting the urge to reduce size when apprehension strikes. It is the unwavering adherence to the blueprint, the triumph of reasoned strategy over fleeting desire, that separates consistent performers from those caught in the emotional whirlwind. To further minimize emotional influence, automating routines or creating rigid checklists can be incredibly powerful. If your platform allows for automated order placement with predefined risk parameters, leverage it. If not, create a meticulously detailed checklist for every single trade. Confirm entry, confirm stop, confirm target, and precisely calculate and confirm position size before any button is pressed. This systematic approach transforms a potentially emotional decision into a cold, hard, unalterable procedure. Finally, cultivating the profound ability to say no is a cornerstone of disciplined position sizing. Say no to impulsive trades that don't fit your criteria. Say no to increasing your risk exposure out of greed or fear of missing out. Say no to any internal voice that attempts to deviate from your pre-approved, meticulously crafted risk management plan. This assertive no to emotional urges is a powerful yes to long-term profitability and sustainable trading. It presents a profound paradox. By embracing strict limitations, Particularly in controlling your risk and position size, you actually unlock far greater freedom in your trading. When you precisely define the maximum amount of capital you are willing to risk on any single trade, the constant gnawing fear of catastrophic loss dissipates. This certainty, ironically born from self-imposed constraint, liberates your mind from the burden of worrying about ruin, allowing you to execute with a clarity and confidence that was previously unattainable. Knowing your absolute maximum loss per trade, and ensuring it's a manageable fraction of your total capital, frees you from the paralyzing fear of blowing up your account. This psychological emancipation is invaluable. You can then approach each new trade not with apprehension, but with a detached professionalism, understanding that even if this particular setup doesn't work out, it will be a small, acceptable loss that fits within your predefined risk budget. This allows for rational decision-making, rather than panic-driven reactions. This consistent adherence to proper position sizing gradually builds an unshakable confidence in your ability to navigate the markets. It's not the confidence born of a lucky streak, but the deep-seated conviction that you have a robust system, and that you possess the discipline to stick to it. This inner assurance allows you to withstand inevitable drawdowns, to learn from losses without being emotionally derailed, and to remain in the game, consistently applying your edge. When the mind is no longer consumed by the primal fear of uncontrolled losses, it becomes free to focus entirely on opportunity. Instead of being defensive and reactive, a trader can now objectively analyze market structures, identify high-probability setups, and patiently await optimal entries. This shift in mental bandwidth from damage control to opportunity seeking is a profound transformation, leading to more proactive and profitable engagement with the market. Ultimately, viewing position sizing not as a mere tactic but as a fundamental pillar of operating a professional trading business is paramount. Just as a CEO rigorously manages their company's financial exposure and cash flow, a disciplined trader manages their capital with the utmost precision. This business-like approach removes emotion, instills systematic processes, and ensures that trading becomes a sustainable, growth-oriented endeavor, rather than a speculative gamble. You now possess the essential truths. The market is a canvas of opportunity, but your greatest adversary resides within. You have the inherent capacity to completely control your emotions and to manage your capital with unwavering discipline. This is not a theoretical ideal. It is an attainable reality. The journey to an unshakable trading mind begins and ends with the absolute mastery of self, particularly in the pivotal act of position sizing. The time for analysis paralysis, for intellectual understanding without actionable implementation, is over. Your next step is to immediately apply these principles. Choose one single insight that resonated most profoundly, perhaps calculating your precise risk percentage, or pre-committing your position size before execution. Take that theory and convert it into an undeniable, tangible part of your trading practice today. The smallest, most consistent action is always more powerful than the most profound, unapplied revelation. Understand that mastery in trading psychology is a continuous journey, not a finite destination. The market will always present new challenges, and your emotions will always be tested. But with the insights gained here, you are equipped to continually refine your internal discipline, to observe your reactions, and to consistently bring yourself back to the objective principles of sound capital management. Every day offers a new opportunity to strengthen this mental muscle. The true legacy of trading titans like Jesse Livermore lies not merely in their monumental profits, but in their unwavering discipline and profound understanding of human nature within the market arena. They recognize that the market mirrors the collective emotions of its participants, and that the only way to consistently outperform was to transcend those very emotions within oneself. This legacy is now yours to inherit and embody. The future of your trading career is not a matter of luck or external market conditions, but rests entirely on your ability to control fear and consistently apply proper position sizing. This disciplined approach will unlock a profound confidence, allowing you to navigate market volatility with an almost serene detachment, opening the path to consistent profitability and genuine, sustainable success. Step into that future with an unshakable mind and an unyielding commitment to disciplined action.